One of the things I'm hearing out of people right now is they're talking about CDs and saying, hey, the interest rates are high, this is pretty good. Now I want to point out something that, you may not be so obvious, that things aren't quite as good as they may appear. If we go back to 1980 and look at CD rates, till now, what you notice is back in the 1980s, we had some pretty high CD rates. Then you see they came down as inflation came down. Then you had this spike over here in recent years, and then it jumped back up. Now, what I want to do is I just want to show a comparison with that and Treasury bills, because I've got way more data on Treasury bills, and that will help to make the point that I want to make here. Notice that Treasury bills, which are short-term government bonds, government's borrowing money for a very short period of time. You notice the interest rates were very high, right? Then they came down just like CDs, right? Then it spiked just like CDs did. And then the higher interest rate in recent years, about 5% right there at the very, very end, okay? So you look at that and go, okay, it's a good proxy. It's a good comparison. What I want you to notice is this. This chart shows us inflation versus Treasury bills. And what I want you to notice is there are a lot of years, the light green is inflation, where inflation is very high, and these short-term investments are paying next to nothing. We're basically losing a bunch of money after inflation is what you're seeing. Matter of fact, if you look at the last 10 years and you compare the rate of return of Treasury bills after inflation, you're losing like 1% per year. I mean, pretty much guaranteed loss over that period of time. Now, if we look at this chart right here, a lot of data on here. And if we look at it, what we see is Treasury bills after and versus inflation over this period of time, the rate of return of treasuries all the way back through history is about 3%. What is inflation? About the same, about 3%. So you basically broke even, and that's it. And after taxes, you probably have a loss right there, right? Now, if we look at large U.S. stocks, it's about 10, which is significantly above inflation at 3. Small companies, about 12 historically. And we look at large value, about 12, and small value, about 14 over here at the very, very end. So what we see there is stocks historically protect us from inflation, because what's inflation? Prices going up. Who's raising prices? Companies. What do you own when you own stocks? The companies. Now, this next chart is really interesting, because what I want you to see here is this. If we look and we say, well, man, Paul, I don't have all the time in the world. You have data going back to 1927. I don't have that much time. I'm older. Right, fair enough. Let's take a look at shorter periods of time. What I want you to notice right here is these are 1, 3, 5, 10, 15, and 20 year periods. What you're looking at are the highest and lowest 1, 5, 10, 15, 20 year periods for both Treasury bills and a moderate portfolio, which is both it's half stocks and half bonds. So it's large companies, small companies. We would be even more diversified than this, but this is just showing large, small, value growth US, and then international large and international small, and then the other half of the portfolio in fixed income investments to protect against the market downturns when you have market downturns. But what I want you to notice is this. Look at the 5-year period and the worst case scenario for the moderate portfolio. And what you'll notice is the worst case scenario was negative 0.5% per year return, which isn't like the end of the world, right? You look at that and you go, wow, that's not, the end of the world. That's not as bad as I would have thought. But look at this right here. Look at the 10-year return for Treasury bills. And you notice something, this line right there is showing us the average return. And notice that the average return is barely any higher than the worst case scenario for a moderate portfolio. So you look at it that way and go, wow, maybe it makes sense to make sure that you have those stocks and various diversification strategies in place, because the reality of it is the odds of you being protected against inflation in treasuries historically is pretty much slim to none, because they have never been designed to protect against inflation. That's why You look at the idea of diversification, the concept goes back thousands of years because it makes sense. As an investor, don't get pulled in by a short-term interest rate that seems high, because we've had them in the past, and typically even after that, we're losing money after inflation. Inflation is here with us because the dollar keeps going down in value. It is a silent tax that can be deadly to a portfolio.